Hello everyone. In this video we're going to continue our discussion for Chapter 5 about accounting for retail businesses, or sometimes we call it merchandising businesses. And in this part we're going to focus mainly on the purchase transaction. We'll start with the purchase transaction. So there are two systems of accounting for merchandising transactions, as I just mentioned in the previous part. We have the perpetual system and we have the periodic system. The perpetual system, each purchase and sale of merchandise is recorded in the inventory account and related subsidiary ledger as it happens. In the periodic system, it's different. The inventory does not show the amount of merchandise available for sale and the amount sold. Instead, a listing of inventory on hand, called a physical inventory, is prepared at the end of the accounting period to keep track of how much inventory is left at the end of the period and how much was sold. Of course, technology makes things much easier with perpetual. And perpetual, the good thing about it is that it keeps or gives you like a continuous kind of track of your inventory balance. But for the periodic inventory system, you have to wait until the end of the period to get to know your inventory balance. Traditionally, businesses with small kind of inventory, like jewelry stores or car dealerships, we're the ones who use the perpetual inventory system, but businesses in retail, like let's say Walmart or Target or grocery stores, was very difficult for them to use the perpetual inventory system, so they relied more on the periodic inventory system. But nowadays, with the help of technology, it's easier to keep track of your inventory on a daily basis. But that doesn't mean that we still don't do the physical inventory. Like these businesses, they still need to do a physical inventory to see if there's any kind of variation between what they have in hand and what they have in the record, because sometimes there's shoplifting, there is items that get broken or damaged. So it's always good to adjust what you have according to the balance. So let's see an example here. So under the perpetual inventory system, cash purchases of merchandise are recorded as follows. We debit inventory because this is one of the assets that are increasing when we buy inventory, and we credit cash because cash is also another asset. When we pay it out, it goes down, so it's credited by the same value here. You see the note here says purchase inventory from Bowen Company, which is the supplier that, or the vendor that provided this inventory. So the T account posting for the preceding journal would look as follows. We are going to have two accounts on the asset side, nothing affecting the liabilities or the equity. So cash went down on the credit side, inventory went up on the debit side. So that's how, and remember, when we are recording a journal entry, we always start with the debit and then record the credit. Let's see another transaction. Purchase of inventory on account. So the only difference here, instead of paying in cash, we bought on account. So we do the same thing with debit inventory because we acquired new inventory, it's an asset, and then we credit accounts payable, which is a promise to pay our supplier, Thomas Corporation, in the future. Usually we have to pay them within 30, 60, in most cases, like the most would be 90 days. But 30 days, 60 days, that's the most common. And you see here, again, inventory is debited and accounts payable is credited. Accounts payable is a liability account. In this case, it's increasing. So that's why we have to credit it for the 9250. So if we look at this on the accounting equation, you can see that under assets we have 9250 for inventory, and under liabilities we have accounts payable credited for 9250. The terms of purchases on accounts are normally indicated on the invoice or bill that the seller sends the buyer. So let's see how the invoice would look like. So here we have an invoice for a company called Alpha Technologies, and this is their address, and we have the invoice number, and they're selling these items to Net Solutions, and the customer order number is 412, so that was like our purchase order number, and then the date of the transaction or the date of the order, the date the items were shipped from the place, which is San Jose, and then this is what is called FOB, or free on board. And when you see the name or the name of the city, Cincinnati, which is our city here, like the buyer, this is called free on board destination. There are two types of shipping agreements: free on board shipping point and free on board destination. So this one is destination, which means that we're only going to acquire the inventory once it reaches our warehouse, once it reaches the destination. But while it's in transit, it's still owned by the supplier or the vendor. And then we have something that we need to learn here, which is the terms. It says here 2/10, N30. And this is an abbreviation for 2% discount if you paid within 10 days, and the maximum you can pay is within 30 days. And then this is the invoice date, which is the same as the shipping date, and it's showing the quantity, description of the items being shipped, the unit price, and the total value of the invoice. So that's the typical kind of invoice that you can receive from a vendor or a supplier. So, one more time, the terms for when payment for merchandise are to be made are called the credit terms. If payment is required on delivery, the terms are cashed or net cash. So we call it like cash on delivery. Otherwise, the buyer is allowed an amount of time known as the credit period in which to pay. So the credit period usually begins with the date of the sale as shown on the invoice. Payment made by due within a stated number of days after the invoice date, such as 15 days or 30 days. And then in these cases, the terms are net 15 days or net 30 days and are normally expressed as N15 or N30. So the N part is the maximum number of days you have to pay the balance for the accounts payable. If payment is due by the end of the month in which the sale was made, we use the term EOM. So N/EOM, which stands for end of the month. So let's see on a calendar how this would look like. So the date of the invoice was January 5th. We have 10 days to receive the discount. So from January 5th until January 15th, if we pay during any one of these days, we're going to receive a 2% discount. So the amount due if paid on or before January 15 would be $29.40, which is the $3,000 minus 2% of the $3,000, which is $60. So that would make it $29.40. But the most, or the maximum, or the latest day, the latest day that we can pay our debt is February 4th, which is 30 days, because remember the invoice had an N30. So starting from day 16 all the way to day 4, you're going to pay the full amount, which is $3,000. So business-to-business purchases may include a discount by the supplier or vendor to encourage the buyer to pay before the end of the credit period. For example, a supplier may offer a 2% discount if the buyer pays within 10 days of the invoice date, which is the example we used. So if the buyer does not take the discount, the total invoice amount is due within 30 days. What if they don't pay within 30 days? Then they're defaulting, and that would create some kind of red flags for this vendor. They're not going to offer them this credit in the future. So everything would be cash on delivery. Once I deliver, you have to pay me. But normally businesses, they try to stay within these kind of agreements. So these terms are expressed as 210 net 30 and are read as 2% discount if paid within 10 days, net amount due within 30 days. Discounts taken by the buyer for early payments of an invoice are called purchase discounts. So these kind of discounts, we call them purchase discounts. So purchase discounts taken by buyer reduce the cost of the merchandise purchase. I want you to be aware that purchase discount is different from something called quantity discount, where you get a discount when you buy a larger order. That's a different thing. And in accounting, we don't have any special treatment for this. But for purchase discount, this is something we have to pay attention to. So assume that in order to pay the invoice on January 15, Net Solutions borrows $29.40, which is $3,000 less the discount of $60, as I mentioned, the 2% of the $3,000. If an annual interest rate of 6% and a 360-day year is also assumed, the interest on the loan would be of the $2,940. For the remaining 20 days, the credit period would be $9.80, which is calculated as $2,940 multiplied by 6% multiplied by the 20 days divided by 360 days, assuming that the year is 360 days. How much did we save? We saved $60, but we paid interest of $9.80 just for borrowing the money for these 20 days. So do you think it's smart to pay it off sooner instead of waiting for the last minute of the 30 days? Yes, it's smart, because in this case you are saving $50.20, because like you saved $60 because you paid $2,940 and you paid interest to the bank that borrowed you the amount at 6% for only 20 days, which is about $9.80. So it's really smart to do that, because and this shows you sometimes it's better for us to pay sooner if we're getting a discount, even if we're going to end up borrowing from a financial institution, because in this case we are saving more by borrowing and paying upfront. So the saving can also be seen by comparing the interest rate on the money saved by taking the discount and the interest rate on the money borrowed to take the discount. The interest rate on the money saved in the prior example is estimated by converting the 2% for 20 days for the entire year. So if we convert 2%, that was for 20 days, we multiplied by 360 divided by 20 days, that's equal to 36%. So it's very smart, because we borrowed at 6%, but we saved 36% interest rate that we could have paid if we waited until the last minute, which is the 30 day. So again, this is just another way of looking at it. So under the perpetual inventory system, the buyer initially debits inventory for the amount of the invoice. When paying the invoice within the discount period, the buyer credits inventory for the amount of the discount. And this way, inventory shows the net cost to the buyer. So let's see the purchase discount here. Net Solutions would record the Alpha Technologies invoice and its payment at the end of the discount period as follows. On January 15th, they're going to debit inventory and credit accounts payable, as we've seen before. And that inventory is an asset, it goes up, so we are debiting it for $3,000. Accounts payable is a liability, it's also going up, and we record it on the credit side. When we're paying, remember, when we pay, cash goes directly to the credit side. So cash is going directly to the credit side for $2,940. The accounts payable is going to go down by the full amount, $3,000, and when I say goes down, because it's a liability, it's going to be debited. But now the cash and the accounts payable are not matching. We have $2,940 and we have $3,000 difference. So the difference, which is the $60, this is going to be a reduction in the inventory cost. So that's why we're going to credit inventory for $60. So again, one more time, we debited accounts payable for $3,000 to get rid of the accounts payable balance that we had, because we paid it off. We only paid $2,940 because we paid within the first 10 days. And then the inventory has to be reduced by $60 because that's the discount we got. So we have to reduce the inventory by $60. So let's assume that they didn't take full advantage of the 10 days, but they just paid in the very last day, which is February 4th. So in this case, it's going to be a little bit more straightforward. We're going to debit accounts payable for $3,000 and we credit cash for $3,000. No impact on inventory because inventory is still recorded at the $3,000. Now let's talk briefly about purchase returns and allowances. And like everybody, sometimes we buy something, we feel like it's not what we wanted, there's a defect, there is a problem, so we need to return it. So how we treat this in accounting. So as it says here, a buyer may request an allowance for merchandise that is returned, or what we call it purchase returns, or a price allowance, purchase allowance, for damaged or defective merchandise. Sometimes the vendor or the supplier would give you an allowance in order to keep maybe slightly defective item or something. From a buyer's perspective, such returns and allowances are called purchase returns and allowances. So that's an account that has an opposite nature to purchasing an item. So we call it purchase returns and allowances. In both cases, the buyer normally sends the seller a debit memo or debit memorandum to notify the seller of a reason for the return, which is in this case the purchase return, or to request a price reduction if it's a purchase allowance. A debit memo would be sent by the seller. So, the debit memo would be sent by the buyer, informing the seller that we want to return these things. So a debit memo, often called or debit memorandum, often called debit memo, informs the seller of the amount the buyer proposes to debit to the account payable due to the seller, or accounts payable due to the seller, yes. It also states the reasons for the returns or the request for the price allowance. The buyer may use the debit memo as the basis for recording the return or allowance or wait for approval from the seller. Usually they have to wait for approval, because what if the buyer did not, or I mean the seller did not approve it? In either case, the buyer debits accounts payable and credits inventory, because it's reversing what we had before. So we debit accounts payable, we're reducing the accounts payable, and we credit inventory, we're also reducing inventory. And this is how a debit memo would look like. Again, it's issued by the buyer, so you see here the name of the company and their address. It's issued to the supplier, which is Maxim Systems, the date of the return or the debit memo was issued, and then they say they're debiting, we debited your account as follows for 10 server network cards, your invoice number, whatever, are being returned, and then each one is $90 for a total of $900. So to show how this is recorded on the ledger or the journal, we simply, on the date of issuing the debit memo, we're going to debit accounts payable and we're going to credit inventory, and we just put a footnote or just a brief explanation that says this is debit memo number 18. So before paying an invoice, a buyer may return inventory or be granted a price allowance for an invoice with a purchase discount. To see an example, assume the following data concerning a purchase of inventory by Net Solutions on May 2nd. They purchased $5,000 of inventory on account from Delta Data Link. The terms are 210 net 30, and I hope by now you understand it's 2% discount if we paid within 10 days. And the maximum or the limit that we have to pay the inventory is 30 days. On May 4th, returned inventory with an invoice amount of $1,000 that was purchased on May 2nd. So out of the $5,000, the business is returning $1,000 worth of inventory. And then on May 12th, which is within the first 10 days, they paid for the purchase of May 2nd less the returns and discounts. So let's see how Net Solutions would record these transactions. So as you can see here, for the first transaction, it's very traditional. We debit inventory, credit accounts payable, since it's on account, for the full amount of $5,000. Again, nothing new here. We debit inventory, credit accounts payable. Inventory is an asset, it's going up. Liabilities, accounts payable as a liability is also going up, but it goes on the credit side. Then we, on May 4th, we returned $1,000 worth of inventory. So what we do is technically reverse what we've done before. So we debit accounts payable and credit inventory. It's just the opposite of what we have done before. And that way we're reducing the balance of the accounts payable and we're reducing the balance of the inventory. So you see here under the ledger or the T account, the inventory is going down by $1,000 because it's credited. Accounts payable is also going down by $1,000 because it's debited. Accounts payable, they have a normal debit balance when we credit, when accounts payable, they have a normal credit balance. When we debit them, we are reducing them. Now we have to pay off the balance. And here's a little bit of calculation. Not rocket science, just simple things. So we had a balance of $5,000. We returned $1,000. So our net balance now is $4,000. And we paid within 10 days, so we're getting the 2% discount. So we take the $4,000 multiplied by 2%, and that would be $80. So the $80 is the discount we're going to get. We don't create an account called discount, we just simply reduce inventory by the $80. So we debit accounts payable for the full value, the $4,000. In cash terms, we're only paying $4,000 minus the $80, which is the discount we receive for paying within 10 days. And that would be $39.20. And then we also credit inventory, reduce the inventory by $80. And in this case, you see that there are three accounts affected: cash, inventory, and accounts payable. But whatever on the debit matches whatever on the credit. So we have 4,000 debit, 4,000 credit. Okay? So let me stop here. In the next video, we'll start talking about sales.